How we doing, traders? Welcome to Money Mitch. Let's go ahead. Let's get it started. Let's talk about what's going on. Of course, on everybody's focus is the CPI data that will be released. Of course, I'm watching it also. The real question, we're going to keep watching. Did the inflation numbers rise? Are we showing a little bit of topping action? We'll talk also about that with our interview coming up next. That's going to be coming up at 4:40. So stick around, guys. We got a lot to talk about. I'll talk about 5 stocks to short. I'll talk about why I'm long TSN. Let's go ahead. Let's dive right in. And welcome to Money Mitch.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now we all know the bull market is here to stay. Money Mitch.
All right, traders, let's go ahead. Let's dive into the market and see what we're looking on out there. And yes, it was a bloody type of day today, deep in the red there. And we'll take a look. We got to take a look at some of these sectors, see what we're seeing on out there and seeing what was weak, what was not, right? We take a look at the hourly. We can see that we didn't even fight up there to the 410s today, but it was just a slow leak. If you take a look at from the open, actually towards the close, it was just only about 1.69%. It was a little bit of it just kind of a stair step down. Right out the gates, we got a little bit down, but since then, it was like about 2 or 3 hours where we just kind of went sideways, but definitely leaked a lot from the close on Friday. So we're going to keep watch. What was weak today? Energy just getting destroyed, right? You guys can see that here, definitely taking a hit. And I don't think anybody was expecting this, at least today. You could take a look at Exxon Mobil and you could see the turnaround on that one coming right back to the 50 moving average on the daily chart. We'll see if it's able to catch a little bit of a bounce here near the 84s and come back a little bit. But man, this was a hard hit on the downside. Now, the real question is this going to continue? One of the things that I've been talking about with MRO is that we've been in kind of this channel right here, and we were looking to see if we were going to come back into the channel, but we've been rejecting to come back up over that hard rejection at the 2840s today. And you can see multiple times we've been failing around that level. Hard rejection today around the 2850s, MRO coming all the way down there towards 24, and it could have broken the trend. And now we're going to start seeing some downside action. It wasn't only in energy, though. I also was seeing the basic materials taking a hard hit. Of course, coal has been one of the ones that we've been trading for a while now. And you could see BTU really starting to get weak. I actually took a little bit of a scalp today on this one as it broke through the 2050s. Going to look for it to break through tomorrow also. But we got to keep on watch. Does coal come back? But for right now, it's definitely showing some weakness. And it's been it's been like 2 weeks of weakness. So it's not like it's just today's or yesterday's weakness. You can see definitely the trend changing in these coal players. Let's go ahead. Let's take a look at some other areas. Technology, of course, taking a hard hit, down 3.72% from the open. We saw stocks like AMD getting hit hard, NVIDIA getting hit hard today, down there to 168. I was actually looking to see if NVIDIA yet on Thursday was going to be able to hold the 200. And you could see there, NVIDIA just not being able to hold on. We'll see what happens in these names. Let's go ahead. Let's continue on over. Let's talk a little bit about what was actually not looking too bad today. It did end just slightly above green here. You can see even on the daily candle, it's actually red there. In the after hours, it just ticked right there. You can see grocery stores not having a bad day today. Sprouts Farm bouncing on back there today. Kroger's bouncing on back. Kroger's 54 is standing out to me right here. As we see, we're trying to recover it now. I'm going to watch to see if this 54 can hold it. Of course, this was kind of like that support from that gap up here, and then we're trying to come right back into that 54. We could take a look at this one, potentially maybe making a move back towards 56 and then trying to make its way back towards 60. We'll see if Kroger's can get moving there. Utilities were also weak today, but Home Depot was a surprise for me. That one kind of came back today after being really weak there on Thursday and Friday. And this was actually looking good on that Wednesday last week. So we're going to start seeing if Home Depot is going to recover a little bit there. And we'll take a look, of course, on basic materials, see how lumber ended the only industry in basic materials that's in the green there. I think that's a little bit of a sign that we can keep an eye out on Home Depot, but we want to see if this comes right back up trending, as we had this trending on up last time we had Home Depot trending on up. If you saw, that was that Wednesday, that was this candle where you also saw Home Depot push on up. Let's see if they can get another ride on up and get on up there towards the 5,000 on this sector outlook. All right, now TSN had a good report here, now pushing back up. We were looking at this stock here on March 28th. That was when it was breaking out of this candle. Just got over the trend. Did a nice little drive on up there. Went up there towards 98. Got up towards a high of 99.54. Now retraced back there to that 90. Pushing off of that level, even though we had a wick. You could see how we wicked down there today, and we kind of cleared right off of that 90. I took my shot of a swing trade on this one today. Right there at the bottom. One of the things that I was looking at was around the 90 bottom, and I was looking for about like 2 or 3 3-minute candles, and you could see how we started getting that reversal sign here. And then right after we got kind of this fifth candle, that was already a 15-minute candle on that 90 minutes. I took my shot coming back up. You could see some volume coming into it immediately, and then eventually it kind of died out on the volume, but pushed back up through that 92. And you can see multiple times just pushing through that 92. Now we're going to look for it to hold 91s on any pullback and really just start driving on up here. If you can take a look, we're going to look to take out 95, then make a move towards 100. This is Tyson Food. Inflation trade. Is the chicken hot? I mean, hey, I've been going to the grocery stores. I don't know about you guys, but definitely doesn't seem like the chicken price is going down anytime soon. All right, guys, smash the like, guys. Let's keep it going. We're going to be getting into our interview coming on next. Guys, I'm super excited. We'll get into our interview with Lance Roberts, Chief Strategist from RIA Advisors. And one of the things that I've been watching Lance is he has his own YouTube channel too, guys. We got to check out that show. We're going to talk all about that. We got a lot to talk about, and we're going to get into some deeper macro stuff. But let me talk about some shorts that I'm taking a look at. Lucid, guys, I've been talking about this short for a while now after their earnings report. You know, they just, their market cap and where their money is, the cash flow, it's just not there, guys. They only made 360 cars last year. I mean, let's just be honest. That's probably not going to cut it in the financials. And in an environment when everyone was looking up, yeah, Lucid seemed like a great investment. Yeah, everything was pointing towards growth, but now everything's pointing against that. And if you have a bad financial sheet, they're coming after you. And I think that this is happening also with Lucid here. Giving up those 20s, now starting to come on down. I got in this one at 1855 on near the close on Friday. We're going to watch to see if this one can continue coming down. I think this one can get to 14. I did take some profit today, like always, securing a little bit of cash. We'll see if this can continue breaking down. There's a couple other ones. Starbucks is one that I've been calling towards the short side also. This one was such a gift on that earnings report. It popped right on up there towards the 80s, got up a little bit higher than we thought. We thought around 81 would get a little bit of a turnaround, more based off of this resistance here. It came up to the second resistance and really just flushing on back down. Starbucks definitely being out of favor. And it's just one of those stocks that I just feel like unless they can do something to innovate, either you hear a subscription model or something like that, they're definitely going to be looking towards the downside. All right, let's keep going. BBW is the other one. This is one that I was actually even looking at put options today. I was thinking about taking the 14 put option for June. And this is just one stock that I just don't understand why it hasn't even gone down. I mean, this is one of those that I'm like, I look at the chart and I'm like, Build-A-Bear? Really? Guys? When's the last time you went to Build-A-Bear? It's been a little bit of a while for me, guys. Let me know if you guys have been to Build-A-Bear and been building a bear there. But I just don't understand why it's been holding for so long. And it's had such a long ways sideways consolidation up here. And you can see last time we were up here in 2015, what ended up happening. Yeah, we fought, but then it eventually just started leaking on the way. That's what I can kind of see happening again. You know, fight. Can't get through that 20. And market environment showing us some downside action and consumer spending coming down could be one to take a look at. I'm not in this one, BBW, but Build-A-Bear, I just don't see how it can hold on here, but we'll see what happens. All right, there you go in the chat. Looks like I have an 8-year-old, so I visited a few times. Miss Whitehorse, you got to let me know. I need some boots on the ground. How's the Build-A-Bears doing? Because I don't even go to the mall anymore. That's where they're located, right? Malls. We'll see what happens there. Best Buy is one of the other ones I'll give, guys, and I'll give a last one after our interview. But Best Buy is another one that I'm looking for it to continue down. It broke 100 and it rejected 100 on the monthlies multiple times to try to get back above that 100. Can't get above that 100. And I think that now you're looking at this 90 level here, and it's starting to look juicy for me for it to get knocked down through there and get back down to those March lows. We'll see what happens on Best Buy. Of course, consumer spending coming on down. And I just think that, just the outlook probably isn't going to be the highest on Best Buy. They might even, who knows, maybe pull back guidance. We'll keep watch of Best Buy. Retail is an area where I could see slowly but surely consumer spending coming away from it. And that's why I'm looking towards the downside on these stocks. All right, guys, let's go ahead. It's time to get into our interview. You guys know what time it is. Smash the like. We're going to go ahead and dive right in. And like always, guys, check out Benzinga, guys. This is where we do it the best.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and educate yourself on credible sites and credible resources like Benzinga. I think you guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out to you and your community.
So I love about you guys, you just had all your callers in right then. And it's all about the community here at Benzinga.
All right, let's go ahead. Let's bring on our interview here. Lance Roberts, the chief strategist from RIA Advisors and the editor of the Real Investment Advice. And check out the show, guys. I also put some links, and you guys can check out his newsletter in the description down below. Welcome to the show, Lance.
Hey, glad to be here. Thank you so much for that. I appreciate it.
Of course, got to go ahead and keep on going. I was watching your show, and I got to say, I love the feel to it. Has that real slash podcast slash radio slash YouTube show slash taking over the world. Hey, got to go ahead and do so. I appreciate it because one of the things that I love doing is talking about more of these kind of macro events and how they're affecting the economy and how they really just tail right into our markets. Right. I sometimes talk about it sometimes that you can have the best stock, but if the market environment's not there, I mean, hey, sometimes stories turn around, right?
Well, no, that's absolutely right. I mean, at the end of the day, it's all about fundamentals and economics. And again, I think 2020, 2021 is such a great story because we saw these young retail traders and they're buying stocks with no earnings and no fundamentals, no revenue, but there were cool ideas and they were innovators, right? And we talk about Kathy Wood and the ARK, kind of ARK investments is kind of the poster child of that. But ultimately fundamentals matter. It may not seem to matter at the moment, and it's always fun to be more bullish than bearish, but when you're putting capital at risk, you have to go back to the fundamentals. Is the company making money? Can they make money long-term? And do they have a viable product? And if the answer is no to any one of those, move on to something else that does.
No, definitely. Let's go ahead. Let's dive a little bit more into you, Lance Roberts, and also Real Investment Advice and how the show works. Tell us a little bit about it, where you come from, and how we could go ahead and check you out after the show.
Yeah, well, so I've been managing money now for about 35 years, so it's been kind of a long road getting here. But I started doing radio shows about 20 years ago, and so and still do. And the show that actually we podcast on our YouTube channel as well as on our website at realinvestmentadvice.com is actually just our daily radio show that we do, and talks primarily about markets, money, and kind of what's driving things. We talk a lot about the Fed, of course, economics. And, this is more kind of from the macro standpoint, because again, if you get the macro right, then the stock selection becomes a whole lot easier. And it's also easier to understand kind of what the risk reward is. And we spend a lot of time really digging into understanding what's the risk, what's the reward that you're taking to get there. Because one of the big fallacies that investors get themselves into is that the more risk I take, the more reward I will make. And that's true only to the point because risk is how much money you lose when you're wrong. And that's really kind of the key issue, is measuring that risk to understand that if something goes wrong in my trade, and we're seeing a lot of trades go wrong here lately, there's a lot more risk than you might have realized you got yourself into.
Yeah, it's a lot of times I say there's risk and then there's ultimate risk, because there's always those kind of trades that, I mean, even if you are calculating your risk, sometimes the trade will go against you, and you'll find out. You better have an ultimate risk, because if not, you hang on tight, and then next thing you know, you're holding another bag, right?
Yeah, absolutely.
I think a lot of traders found that out the hard way this time around, and it's always like that, right? I mean, there's cycles of waves, and I think the question you always got to ask is what environment we're in. So I'll ask you, Lance, what environment do you see out there, and what's the market sentiment that you're seeing?
Yeah, so it's very interesting right now, because I've been through 3 bear markets. I was in the crash of '87, in the crash of 2001 and 2. I went through the crash in 2008. And what's interesting is that, and we were writing articles about this over the last couple of years, is that a lot of the sentiment that we had in the markets was very similar to what we saw in 1999. And that's kind of one of the key, high valuations, and of course this kind of there's nothing can go wrong. Markets can only go in one direction, that's higher, and you're crazy to be in cash. That was the type of mentality we saw back in 1999 to a large degree. And where we are now still feels like we're kind of in that, early to mid cycle of that type of a market, where, the markets are going to do everything they can to frustrate you. As a good example, right now, markets are 3 standard deviations oversold below their 50-day moving averages. And, that's a very oversold condition. And this is where investors start going, man, I just got to get out of the markets. Everything's going wrong. Nothing I've got's working the way that I thought it was. And this is typically where that emotional side of the market starts driving you out of stocks and into cash at exactly the wrong time. And if you go back, and 2020 was not a bear market. And this is where a lot of people really, they argue with me a lot over this. A bear market doesn't end in a month and then immediately go to new highs. That's a correction. And yes, it was larger than the 20% drawdown that we kind of arbitrarily assigned to bear markets. But the function of how bear markets work is this grind lower, and it takes a while to work through a markets. And at the bottom of a bear market, nobody wants to own stocks. In March of 2020, everybody couldn't wait to get back in. So, that really wasn't a bear market. And going through that, it was so fast, and there was not lessons that were taught. Now we're teaching people lessons about risk. We're teaching people about the lessons of investing in companies. You were talking about Lucid a few minutes ago. Rivian's another good example of this. Companies that may have a great idea, but they don't have revenue, they can't generate product, and they can't create sales. This is going to be a penalty that a lot of people will pay. And at the end of this cycle, whenever it ends, and look, this doesn't mean that stocks have to go down 50%. We've done a tremendous amount of damage in this markets already. If you take a look, and I did this study last weekend, weekend before last in our newsletter, is looking at these stocks. If you look at market cap above 7 billion, every stock in the universe, there's a tremendous number of companies that are trading 30, 40, 50, 60, 70% off their highs. And all the names, right? Carvana and Roku and all these stocks have been just completely, blasted by the market. So a lot of that work of a bear market has already been done. And the markets, though, are only down 14, 15, 16%, whatever they are right now from their peak. But that's because of the mega cap weighting of those top 10 stocks, Microsoft, Facebook, Apple, Google. Those are still holding up the market. So it may not seem like we're in a bear market right now, but we really are. And we've done a good bit of work. So I would suspect that the Fed's got a lot less room to work than they think they do. And that we might be, talking about the next bull market opportunity maybe later on this year.
Yeah, I mean, if you take a look, you're starting to see at least the leadership start coming down, and I mean, if you see the IWM, that shows you a little bit more of that weakness that we're seeing out there. I have a mentor that Dennis Dick that talks about how the .com era, it was a lot of the death by 1,000 cuts, just cut, cut. And it's similar to what you're saying there, that a bull market, a bear market usually isn't going to V bottom like that. I mean, like we saw in 2020. I mean, that just and there's a reason why there were so many that got left with money on the side, right? I mean, that was like a 1 week bear market there. I mean, I was there on Thursday, like, okay, maybe next week Thursday we can start taking a look at it.
Right.
But it was like that. And then by that Thursday, it was already up. It was like, man, all right, okay. Yeah. But the real question is, and I think we're starting to see it now, is I think a lot of this drew inflation into the market, right? We had a lot of pumping of money. Some people like to say the printers never stopped, but we could take a look at it. How are we looking at CPI data here? Are we starting to get near the topping action? Do you think inflation's turning around? What do you see, Lance?
Sure. So a couple of things. One, let's I want to touch on two topics real quick, because this is one thing that, I talk about this a lot with people. QE, quantitative easing, what the Fed does, is not inflationary, right? It's an asset swap. So all they're doing is they're crediting bank reserves in exchange for bonds. So they're not creating money supply. Milton Friedman once said that inflation is always and everywhere a monetary phenomenon. It's not, and that's where usually the quote stops. But he goes on to explain it's not a function of consumers. It's not a function of pension funds. It's not a function of evil corporations, hoarding profits. That's not what causes inflation. What inflation is caused by is by the government printing money. And that's exactly what we saw in 2020, 2021. And that free money, as the old saying goes, there's nothing ever free in the world. And, there's no free lunch. And what we're experiencing now, that inflation, is the payback for that free money. And so now it's interesting, because I was doing an interview today talking about Biden is talking about potentially doing more printing. So he wants to try to help people with high gas prices and high food prices and high childcare. The reason we're in this problem is because of that free money. If you put more free money into the system, it's only going to make things worse. And this inflation will continue to run. Okay, so now that we know the difference between what causes inflation and what doesn't, now we can talk about where we are in inflation. So two things. One is that we measure inflation. This is a key factor. We measure inflation on a year-over-year basis. So if you go to the store right now, the gas station, and fill up your car. So in Texas, we're paying about $4.20 a gallon right now for gas. If gas is $4.20 a year from now, inflation is now zero. Even though the price of gas didn't change and I'm still paying more for gas, my personal inflation is still high. The way we measure inflation is that inflation will fall back to zero. So the reason I bring this up is because this month, so on Wednesday, we're going to get the CPI report. And this is the first month that we're going to compare to a month where we had positive rates of inflation. And that was the beginning of that inflation push in 2021. So as each month progresses now going forward, that year-over-year comparison is to become much more challenging. So just think about it this way. Next year at this time, we're going to be comparing to 8% rates of inflation. So inflation, just by the very function of how we calculate it, will start to come down. Now, this month, the month of April, we may not see much of a moderation because the positive tick in April of 21 wasn't that big. But over the next couple of months, that year-over-year comparison is going to increase pretty sharply. So we're going to start to see inflation rates come down. Now, having said that, that's just assuming everything remains status quo. And then I'm going to shut up. The other side is that used car prices, the Manheim used car index is just completely falling apart right now. Consumers are tapped out. We've seen a lot of push on credit cards. You take a look at what's happening to some of the ISM production indexes, employment indexes, et cetera. Those are all starting to roll over. Wages in the last report and GDP was already showing signs of weakness. That's going to feed through and create more disinflation as we move out further into the year. So economic slowing, higher interest rates, and that's not even talking about what the Fed's doing. This is just, we got 3% interest rates in the market. That's all pressing on those very areas of consumer consumption, and the economy 70% consumption. So higher rates, higher inflation leads to less economic growth, aka less inflation. So yeah, I think we may have seen a peak, and it gets worse as we go forward.
Yeah, when we start seeing the market get hit like we're seeing on today, do you think that there's starting to get some of that forced selling from investors? Do you feel like some investors are getting that feeling?
Two things was interesting about today. One thing that so let me back up. Two things. One is that this sell-off this year has been very orderly. It's not been fun. Don't get me wrong. It's not been a fun market to be in, but it's been very orderly. We've had declines. We've had nice rallies to sell into. It's declined again. And as I said earlier, we're very oversold. We're very stretched to the downside. We're going to get a rally here of some sort. And I would certainly use that rally to sell into, reduce exposure, et cetera, because we're not out of the woods just yet by any stretch of the imagination. But it's been a very orderly rally. Today was really the first day that, I'm starting to see some retail capitulation, right? I mean, we're just starting to see people just sell everything. And now they're selling the good stuff, right? So you saw that you were showing two holdings that we actually have in our portfolio earlier in your show, Mitch, ExxonMobil and Marathon Oil. We've been trimming those for the last few months. We were talking about buying energy back in November of 2020 because nobody wanted to own energy, and we said this is a good time to own it. Now everybody wants to own energy, so we've been selling into this rally as this rally goes up and raising cash. But now there's a lot of pockets of the area of the markets that nobody wants to own. Nobody wants to own bonds. Nobody wants to own tech or growth. Nobody wants to own communications. And there's starting to be some real value in these sectors, on a longer term basis. But, we're going to pick up that rotation in the market at some point, and you're going to get a pretty vicious counter trend rally. And when you do that, I would certainly use it, like I said, to sell into, reduce some risk, take some opportunities if you want it on the short side. But, this market's going to be volatile for the rest of this year, most likely.
Yeah, definitely. It's something that I've heard you use the term reflective rallies in the work. So, I mean, we could be getting one of those. I mean, especially when we get these extreme days.
Yeah.
And that's how we've gotten the rallies before, right? Another thing to keep on watch, of course, the RSI. Does it keep coming on down or not? We'll continue watching. I know that's on your radar, Lance. I saw it in the newsletter. You guys check out that newsletter. It's in the description below. You guys can check it on out. I know I found it on LinkedIn, but you guys can find it right there in the link down below. All right. The dogs are barking. And when the dogs go barking, you already know the consumer spending goes down. So, Lance, what are you thinking? You thinking consumer spending is starting to top off too? Like,
Yeah.
I myself, I'm starting to feel it. I'm like, well, I don't know, honey. Are we moving out of the Dove? Are we going to go into some cheaper soap here or something? But
no, you're going to definitely see that. So, one thing is very interesting. And going back, we saw so many distortions caused by that. Those checks to households, et cetera. And what we saw, and look, this was a good thing, right? People got checks, they went and paid off their credit cards, and that's great. I mean, financially, that was very smart for a lot of people. Then they went out and they spent money on other stuff. And so we had this big decline in credit card debt. We've now seen credit card debt go right back to the peak of where it was before. And all that's telling you is two things. One is that consumers are when inflation was coming, they were still spending. And there was a lot of comments in the economic data about, well, the consumer is still strong. Don't count out the consumer. And that was true because they had some extra room on the credit card. And now they've used up most of that excess credit. So consumer spending is already starting to sign some cracking here. Like I said, used car prices starting to come down. We're starting to see it in weakness in some of the retail sales data. Real retail sales, inflation-adjusted retail sales are actually heading towards negative territory as well. Disposable incomes on an inflation-adjusted basis are negative. And here's the point about this is that, remember this one thing about retail sales, and when we talk about consumer spending in general, is that we talk about this in dollar terms. And you said it earlier, also talking about this and talking about going to the store and swapping out for Dove for a cheaper, kind of off the shelf brand. Those are the first changes that people make. So they swap out, they substitute for lower price goods. The next thing they do is stop buying those goods altogether and just basically cut back on spending wherever they can. And this is something that we have yet to see, but that's coming. Because remember, when we talk about, gas sales, we were talking about gasoline a few minutes ago, and it's such a good topic to talk about. When you fill up your car every time with the same number of gallons. And I mean, the car just doesn't magically hold an extra 20 gallons, right? There's only so much that'll fit in the tank. So when we measure those gasoline sales, we measure them in dollars. You're not buying more gasoline, you're just paying more for it. And it's the same thing with food. We don't generally buy more food, we just pay more for it. And so we're seeing this in all these areas that are starting to seep into consumer spending, where they've got more dollars going out. They've now ramped up the credit card debt to try to shore up the difference to support the standard of living. And the next step is to start reducing that standard of living and curtail consumption. And I think that's what we see as we move further into the summer and later this year.
Yeah, I mean, Netflix already kind of hinting towards that, right? I mean, we already see it there. The streamings are going down. They're like, well, honey, we're either keeping one of these, Disney Plus, Netflix. We can't keep them all. But let's go ahead. Let's talk about where does this all turn around? And maybe it's at the end of 2022, or maybe it's a little bit further from there. What do you think it's going to really take for us to really start giving an upside look, at least looking forward?
Yeah, so a couple of things. One, and I think we may be a little bit further into this cycle than what a lot of people think. It's too early to tell. Because we don't know what's exactly priced in just yet. We don't know how fast things are going to revert in terms of inflation and economic growth. But look, we're going to probably have a recession, and unfortunately, you won't know we're in a recession until after the fact. So here's the things to kind of look for. Look for this, kind of very restrictive consumption structure that we were just talking about a second ago. Look for that real cutback in retail sales. Look for unemployment, to start rising. Look for jobless claims to start rising as well. Those are going to tell you that you're actually in a recession and that you're actually heading through that process. And then, of course, the key factor is going to be when the Federal Reserve says, okay, we're not hiking rates anymore, and we're not going to reduce our balance sheet anymore. Doesn't mean they have to start reducing it. They will ultimately. It doesn't mean they have to start, but when they stop, that's where you want to really start looking through the rubble. And that's, because we'll be close relatively, we might be a little bit early, but we'll be pretty close to the bottom of the market at that standpoint. And again, that could be 10% lower, could be 20% lower from here. Could be right where we are right now. Honestly, this market could just kind of chop around sideways and just hang in here for a while and work off those overvaluations. So we're doing a lot of that work already. And the question is going to be, really, does the Fed break something? That's the real question. When they're hiking rates and reducing their balance sheet, do they break something in the credit markets, or do they break something economically that leads to a very sharp reversion like we saw in March of 2020? Viable opportunity. But that's the risk that you've got to be aware of.
Yeah, definitely. I think we all will be watching the housing markets to show if there's any kind of weakage in there. How's the lending in there? Is there any credit risk there? We're going to find out. I think, definitely with the raising of the interest rates and the outlook of continued raise. I don't think we'll get to the 7 or 8 hikes that everybody talks about, but I don't think you see that either, Lance. But,
No.
Hey, they're definitely going to raise, at least that we could definitely kind of get that feeling. I appreciate you coming on here, Lance. Tell everybody how they can go ahead and find you on an everyday basis right there on YouTube or on kind of your website.
Yeah, no, honestly, the easiest place to go to is go to our website, realinvestmentadvice.com. You get access to all of our YouTube channel, our 3 minutes on markets and money that we do every day. All of our we write blogs during the week. And all of our blogs and our newsletter is simply us doing research. And basically, we just publish the research that we use to manage our portfolios. And we're longer term investors, and so we're risk managers. We're not trading as such, but we're looking for longer term capital appreciation and growth with risk management, risk controls, and capital preservation. So that's our big function, and you can find all of that. You can find our digital platform service as well, all at realinvestmentadvice.com.
Yeah, check it out, guys. They had some great graphs. I'll give you a little quick sneak preview there. You guys can check it on out there.
That's my favorite one on RSI, by the way.
Hey, you got to have some good ones. And I saw retracements on there, statistical data. I know how much you guys love the statistical data. Yeah. So check it on out. Thank you, Lance, for joining me. We'll have you on again.
I appreciate you. Thank you. Bye.
All right, guys, that's going to do it for us. I hope you guys enjoyed that interview. Going a little bit of extra time into 506, so please drop the like for us if you guys enjoyed that interview. I love talking about some deeper topics. We talked about inflation. We talked about the market sentiment. What I loved is how he talked about specific factors that he sees that could be topping out that inflation, right? That credit, the used car sales finally coming on down there. Are we finally starting to see the consumer and kind of that demand destruction on out there? We'll take a look. Like always, stay with us, guys. We'll be live trading tomorrow. Could be holding that lucid trade to continue on down. Could be taking some other shorts. Check it on out, guys. Live trading with Benzinga starts up every day at 9:05. I'll see you guys there, and keep going, guys. Up next, you guys got a little Web3 action. Go check out some crypto talk. I'll see you guys next time right here on Money Mitch.